Hello everybody, and welcome to another episode of Options Discovery on John Lothian News' The Spread. My name is Alex Teng, and just like you, I am no expert in the world of options. But with the help from some, we can learn more about options together. In this week's episode, we're going to be talking about the bear call spread and the bear put spread. We also get to sit down with former floor trader and lead mentor at optionthinker.com, Dan Keegan, where he's going to walk through some live trading exercises in this week's interview. So it's something you're not going to want to miss. All right, let's get straight into the episode. Okay, so before we get into the bear call spread and the bear put spread, let's take a second and talk about what a spread trade actually is. And a spread can mean a lot of different things in the trading world. But it's essentially a strategy that uses multiple options to take advantage of price movement or even lack of price movement. Today, this is going to be done by taking simultaneous long and short positions in either a call option or a put option. Okay, so now that we know what a spread trade is, let's talk about the bear call spread. Now, the basic bear call spread is achieved by simultaneously taking long and short positions in options with the same expiration date. Now, this is a strategy you want to implement if you are moderately bearish about the price of the underlying asset, which essentially means you think that the price of the underlying is going to go down. Now, the general idea with this strategy is that you're going to sell or write a call option with a low strike price, and you're going to buy another call option with a higher strike price. Now, the option that you sold for a lower strike price is going to have a higher value than the option that you bought at a higher strike price, which means you receive more premium upfront than you would pay. Now, this is because the option with the lower strike is closer to being in the money, which means that the value of that option is going to be higher. So the call that you bought at a higher strike price is essentially limiting the maximum loss that you can have on this trade. And this is important because if you didn't have this call option, you'd essentially be writing a naked call option, which would expose you as the trader to an unlimited downside potential. So this means that the maximum a trader can gain from a bear call spread is the premium of the written option minus the premium paid for the option that is purchased. The maximum value a trader can lose from a bear call spread is the premium earned on the short call minus the difference between the strike prices, minus the long call premium. All right, so the next strategy we're going to go over is the bear put spread. And this strategy essentially involves buying one put option at a high strike price and selling or writing another put option at a lower strike price. This is another strategy you want to implement if you are bearish about the price of the underlying asset, which again means that you think the price of the underlying asset is going to go down. For a short put spread, you are essentially paying a net premium, which is the difference between the premiums of the long and short put options. The basic idea is that you can decrease the cost of the long put by essentially sacrificing some of the upside. The maximum possible profit for this strategy occurs when the price of the underlying asset is lower than the strike price of the short put. This profit is equal to the difference between the two strike prices minus the net premium you paid for the strategy. The maximum loss from this strategy occurs when the price of the underlying asset is above the strike price of the long put. This loss will be equal to the net premium of the strategy, which is the premium of the long put minus the premium of the short put. It is also important to remember that there are a lot of other factors that this strategy is exposed to that we didn't necessarily cover in this video. A good example being transaction costs. So please look out for that when you're trading these types of products. Now, in order to get a more in-depth look at the bear call spread and the bear put spread and how a trader would really implement it, I sat down with former floor trader and now lead mentor at optionthinker.com, Dan Keegan. In this interview, Dan actually goes through some live trading exercises, which is really exciting and a first for the show. So please enjoy my interview with Dan Keegan. All right, everybody, welcome to another Options Discovery interview. Today we have longtime trader and head mentor at optionthinker.com, Dan Keegan. Dan, can you please introduce yourself and just give us a little rundown of your background and education experience?
Yes, background is when I got out of college many decades ago, I got a job as a business analyst at Dun& Bradstreet, and that just wasn't doing it for me. And I like many other people who grew up in Chicago, they knew about the trading floors. I knew nothing about it. A friend of mine told me about it right away. I was intrigued, and I said, well, that's what I want to do. And I started out as a runner for a company called A.G. Becker, which hasn't existed in a long time, but that was the premier company to go. It paid the least, but it educated you the most. So within a couple of years, I had a badge on the trading floor. It was a great time to be starting at that time because it was just growing like a weed. The whole business was. So it was great. Market maker for about 25 years on the CBOE, a little bit of time as a local on the board of trade, and also been educating for about 12 years now, and still trade, but not as a market maker, as a market taker. So, but yeah, I think options is the way to go for anybody who's interested in trading. It just gives you the best risk reward, defines your risk. Unlike if you're just trading futures or Forex or stocks, it's a binary outcome. It goes up or down. With options, there's a million different ways to skin the cat. So a million exit doors is a million entrance doors. And once you understand how it works, you got the risk reward in your favor. So
for our topic this week, we have two option strategies that we'd like you to break down for our viewers. And the first one is going to be a short call spread. So can you describe what this strategy is, when you would use it, and just a little bit about the basics?
Yeah, a short call spread is basically, here's a little bit we could go over. All right, so here's what you look at when you're selling a vertical call spread. So here we have the 366 calls in Spider that expire October 21st. Okay, that's like a week from tomorrow. So we could do it just selling a naked call at $6 and let's say 57 cents. Okay. All right. So if we're looking to sell a vertical call spread, let's take a look at Spider, which expires a week from tomorrow, next Friday. Okay. So we're going to sell it at $6.57. Okay. We'll take a look at that. So we'll take a look just selling at 20 a lot. Okay. And here it is. So we get 657. Okay, so that's $657 times 20. Okay. So we got about $13,140 that we can make. All right. Here's the blue line is the expiration graph. The black line is today's graph. All right. So if this option trades, if the closes at 366 or lower, the option will go out worthless because nobody's going to want to exercise a call that gives you no advantage. Because if it's at 366, you exercise a 366 call, you could do that in the open market. So anywhere 366 or lower, you make the maximum profit, and you make the 372.57 would be the break-even point right here. Okay. So this is the maximum money you would make doing it this way. However, there's a tremendous amount of risk, particularly in this marketplace where we've had huge moves. Like today was a massive move up. There's been massive moves down. So you're looking to buy a little insurance too. Okay. So in this case, we could go $10 strike price out. Okay. Sell the 366 and buy the 376. Okay. And we buy the 376 at 265. Okay. So basically we got 357, 372. Okay. So now we're going to look at see how much money we can make on this. Here's a classic short vertical call spread. Okay. So the most we could make is, once again, it's going to be below 366. Okay. So we're not going to make as much money as we made the first go round. Okay. Because we're reducing our profit by the purchase by $2.65, right? Because we're collecting 657, we're paying 265. So 657 times 20, we're going to make that 13,400. Okay, we're reducing 2,000, reduce 12,000 or 5,300. Okay, so we're taking that out of it, and that's what our maximum profit will be. All right. So this is a $10 vertical spread. All right. Because let's say it closes above, it closed at 357. All right. Or it closed at 377. That means both options will be in the money, right? So I would exercise a 376 call. Okay, that's because it's in the money. So I would be long the stock at 376. I'd be short at 366. Okay. So that's losing $10. All right. But I got the original 357, 360, 372. Okay. Credit. So I would lose 628. Okay, on this. So that's a losing proposition. All right. If it goes above, but once again, we saw the earlier graph where it was unlimited. Okay. Literally unlimited. So that's so at least if we're bearish, and this is what we do, you want to do this versus the naked call. Not only that, the margin is so outrageous that it's difficult for you to carry this position and other positions. All right. Now the black graph is that's your position today. Okay. So you start losing money. You see over to the right, you're still not losing your maximum amount of money as you are down here. That's because you still have time value in the call that you're long. Okay. So that a spread doesn't get to its full $10 value until expiration, when the time value is sucked out of both the long and short. Okay. Now, in trading, putting on a position is one thing, managing it is the other thing. People buy these newsletters like, what's a good trade to make? Well, establishing a trade is probably counts for 5% of your profitability. The other 95% is managing your trade. So as it starts to heading up, since this is a bearish trade, you have to do something to change the dynamics of the situation, which means it moves up. What you want to do, maybe there's three things you could do that would be bullish, that would counteract that short call spread. Okay. And the three things are, you could sell a put, right? Because as the stock goes up, a put declines in value. Or you could sell a put vertical like this. Okay. Either way, you're moving your P&L further to the right. Okay. So as it goes up, you're changing the nature of your trade. The other one is you could buy a couple hundred shares of stock. Okay. So if you bought it as it's at 367, for instance, okay, and it goes up to 376, that's $1,800 you bagged if you bought 200 shares. And as it keeps going up, you could buy a couple other 100 shares of stock. Okay, so you're changing the nature of the position as it goes up. So you could buy extra calls. Okay, let's say it starts to move up, you buy a 360 call. Okay, and it keeps going up, you buy maybe some other calls, or you could buy a call vertical on top of this vertical. Okay, the short vertical. Okay. Go ahead.
No, that's really interesting. So just to kind of summarize, I guess, from our viewers' perspective as well, this is this type of vertical short call spread is something that you put on when you're bearish, but you don't want necessarily that exposure from just selling a naked call. So then you can buy the call option again at a higher strike price, right?
Right. You buy a call at a higher strike when you're first establishing the trade. Exactly. And you've now limited your exposure. If you just went into a coma for the next week, which is never a good idea for a trader, then you define your risk. But you should always be redefining your risk as it starts moving against you. You would want to do that, or even if it starts moving in your favor. Because look at this: if it is below 366, it could be all the way down here to 351.50. And you're still haven't maximized your profit, only when it gets so far down that it has no hope of getting back up above the 366 that you originally shorted it at. Okay. So it's in here, you might do something as well. Okay. So there's a number of things you could do, knowing, okay, you made that. Maybe I'll put on something that's a little bit bullish. Okay. So that if it reverses course, I'll lose on this original that I shorted, but I'll make on the adjustment that I made. So you'd be digging into some of your ultimate profit if you left it totally alone. But by hedging it, you're helping yourself out if it ricochets back up. It also reduces your margin so you can put on other trades. So you're always looking to adjust if the trade goes in your favor or it goes against you.
And that's what you're talking
out with a spread position, because you could carry this overnight. If you have a naked call, it could make just that big boomerang move and you're screwed. So
yeah, of course. And that's one of the biggest risks of with writing a naked call. But I thought it was interesting when you mentioned what you've just talked about for a little bit, but managing that position and the different tools that you listed there. And that kind of leads into a little bit more than just the basics, but figuring out and making your own opinion on how you want to trade, and that kind of goes into the thought process of a trader. So like as a hypothetical example, if you started seeing that upward move maybe to like 368 or 370, which one of those tools would you use, or is it really dependent on what the greater situation is with your portfolio?
Yeah, it kind of, well, it depends on the size of your portfolio. If you have a few $100,000 on it, you could just buy some shares of stock right away. Okay. If you're starting out, you have a smaller account size, buying stock would be really expensive for you. Okay. So you might want to not do that, but you could certainly short a vertical put spread. Okay. Which, as it goes up, that would lose its value, which would be good for you since you're shorted. As your short call spread goes up in value, and you're losing money on that. So I would like short a put vertical, or buy another call down. For instance, you got short the 366.76 spread. If you bought like the 363, 368 spread, okay, like buy a $5 vertical, and that's going to be moving up as your basic one goes against you. So maybe just do that, change the nature of it, or you're just adding deltas, which means equivalent shares of stock. Okay, because when you have the short vertical call spread, you're kind of shorting shares of stock, even though in an equivalent way. Whereas you want to do something that but to answer your question, I would probably throw another vertical on that was a bullish one against it. Okay, as it's moving up, as your account size grows, and sometimes when it makes a big move, buying stock is the quickest and it's easiest to fill. So, but just do anything to change the nature of it. Okay, now it could snap back and you'd be like, oh, why did I do that? But that's the way trading is. You always have to be doing things on the fly. So
Yeah, that's a really that's very interesting, the different tools and how your account size and other factors can really play into it. You also mentioned, that you would put on a short vertical put spread as well. Can we go over that one as well?
Sure. So yeah, here's just the same spread, but we're buying the 366 puts and selling the 376 puts. Okay. Um, although this time it's bullish because we're shorting the higher strike put. Okay, so the higher strike put is always going to be the bigger put, right? So if it gets up above 376, both options go out worthless. So you're selling this for let's look at the options here. 376 puts. Let's say we sold that at 1280. Okay. And we buy the 366 puts at 675. Okay. So we're selling it for $6.05. All right. So the most a spread can ever, vertical spread can ever be worth is the differential between the two strikes. Okay. Because once again, if this got in the money totally, we would get a sign on our 376 puts, which means we would be contractually obligated to buy the stock at 376, but we have our insurance policy here that gets us out at 366. Okay. So then it would be worth its maximum amount, the $10. Okay. But since we have a $6.05 credit, we would only lose $3.95. Okay. So, and you could do different strikes for this. For instance, let's say you did 362 against 368. Okay, so we're selling this $6 spread now against our $10 spread. Okay. And that's, so this is what the bullish spread we'd be having on. Okay. So
And what would lead you to put on a wider or shorter spread value? So why would we do the $10 versus the $8? And
well, let's say it's starting to move up. Okay. So we don't want to shoot the works right away. We just want to get a smaller profit working for us as it's moving up. Okay. And because it could stop there and it's taken care of, right? If we buy a $10 spread against our $10 short vertical and it reverses course, then undoing it's going to be costly. So it's just taking like a little bite out of the apple as you're going up. So does that make sense? You're just rather than
the smaller spread allows you a little bit more flexibility, especially if you have to reverse course if the trade's not going your way. Is that kind of what you're getting
exactly at? Yes. So you've got a problem. It's not a disaster yet. You take a little bite of the apple. The problem is solved. If it keeps going up, take another bite of the apple. Okay. So you're massaging as it's going up, and then as it keeps going up, you can do some things to adjust those put spreads you shorted in case it does reverse course. Because as it keeps going up, they'll lose money and your initial spread will lose money, but hopefully you've done enough so that you've actually going to make money overall on it. And you're worried if it dips down again, then you have to go in again to buy like something underneath that will profit if it goes all the way down to cancel out the adjustment you made. So you're kind of adjusting to the adjustments as it goes along. So
that makes sense. And it's harder to do that if you're increasing that spread size because it's a lot easier to get caught on that.
Correct. Yeah. So you're just you're betting, okay, I'm panicking, it's gonna go all the way up, I'm gonna do this, And if it kept going up, you'd for sure make money. But so when things are going against you, if you can turn the losing trade into a break even or a slight profit, that's a huge victory. I'm just as happy with that as when it's going my way and I'm just going to make a lot of money. But even then, as I said, if it's going your way, you still want to adjust on that as well, because you want to cement some of your profits so that it's going to cost. It'll ultimately take away from your perfect profit if you just let it go. But over the long haul, over a year's time, if you keep doing little things like that, you're going to be much more profitable, because those big moves against you will kill you.
One thing I want to talk to you about as well is optionthinker.com in particular. What kind of programs do you offer students? So if someone comes to you and they say, I'm looking to get mentored at optionthinker.com, what kind of programs do you offer to them?
Yeah, basically the basic program is just one-on-one mentorship. Okay, because I've done 2-on-1, and that's about 1/4 as effective as one-on-one, because as I'm teaching somebody, I can tell just by the tone of their voice whether they get it or not. And I don't even have a picture of myself and the student up there. I just have the option chain. So we're just thinking of that. I'd say, okay, well, and I'm just constantly pumping them with questions so that they answer instead of just me, giving platitudes out every 5 minutes. It's just, why would this happen? And their brain is being activated and doing that. So it's like a 6-month program. I wrote a 210-page book. I give anybody who registers, I give them the book, and okay, cover this amount. We do first 4 sessions just covering the fundamentals, and the next 4 months, that's the first 2 months, next 4 months is just simulated trading positions, which they learn to manage. And usually when they, like the first 4 sessions of the fundamentals, it's very difficult for this to stick to somebody's brain. It's like, oh, that makes sense, but when I ask a question, it's just like, oh, but there's a moment where, oh, okay, now it's making sense. And that's like a quantum leap. And then they start the simulated trading. And it's usually the first 2 or 3 sessions, I'll ask them, why'd you do this? And I could hear a pin drop. They're still not confident in terms of putting it into use. But by the last 2 or 3 sessions, they'll do something I never would have thought of, but it's within the same risk reward framework, and it works. And that's the whole idea is, maybe they could do the same as me or maybe not, but the whole idea is learn how to think on your own and do it from a solid risk reward perspective. So at the end of 6 months, they're ready to use their own money to make money. So
That
basically how the program works.
That's a great program. And is it just, so you said that's the most common type, is one-on-one. Is there ever any times where you're doing seminars or group sessions that people can look for as well?
There's occasionally, like I'm doing one in Croatia that has like 15 different people at one time, because that's just the way they wanted to do it. So that you can, but I would highly recommend the one-on-one. That definitely gives you the best, the quickest way to ramp up your skills, and the solidest way to learn it. So, because when you have even 3 people, one person's going to be way ahead of the other, and then maybe at another person, that other person, but it's just choppy learning. It's not. So for something like this, I mean, that'd be true in anything where you're trading, but for trading, it's something where you really want to be learning from one person. Like I said, the example of an electrician, he's going to bring an apprentice along with him. He's not going to have 40 people in there and say, oh, here's what I do. You're going to learn how to do it that way. So,
yeah, that's very interesting. And so I like to talk about that to hopefully get that out there to the viewers, that is also a program that they can look into themselves. And so as we kind of close out this interview, I have a few closing questions that I ask every guest. And so the first one would be, while working in the options industry, so either that's, on the education side or when you're on the market making professional side, what was the most valuable lesson that you learned, or what piece of advice would you pass down to someone that's looking to get into trading?
Well, I would say, are you excited about it? Number one, if you're excited about it, that's probably more important than anything, because if you're not excited about it and you try to learn it, you're not going to have you need the excitement level. So you're just going to be all in, because it's not easy to learn it at the beginning. it's kind of like a new language entirely. But a lot of the people I teach are IT people, so it's similar to that in a way, but it's different. But a lot of them are attracted to it because it's kind of somewhat similar to that. But yeah, so I would just say be very excited about it, be very dedicated to it, because it like, for instance, 6 month thing, you got to average at least an hour a day dedicated to it, because you can't like take a week off. And then anything mathematical is kind of like, it just builds on everything else. So I would say, yeah, do that and just make a commitment, and then it's up to you once the real money is on the line. So
Great. And then the last question is every week, so we choose a new topic for the show. So this week we were going over the short call and short put spread, which you helped us demonstrate today. Is there another topic that we should go over, or what is the topic that you think that we should go over in the future with another guest?
I think just look at a simple long straddle. Okay, that's where you're doubling your break-even point in either direction, but it also gives you opportunity in either direction. That would be a good one. Or a simple time value spread, where one expires sooner than the other, but it gives you the opportunity to show how advantageous that can be, or if it goes against you, once again, how do you adjust out of it? So
Great.
those are the two ones that I would think, or even a long vertical spread goes against you, convert it into a butterfly, so your risk is lessened, even though if it winds up in the same place, you'd still be making money. So
Great. Yeah, those seem like great topics to kind of go to next with the show, and I really appreciate it. And I really appreciate you taking the time today, Dan, to speak with us and share all this information with the viewers. I know it's been a very, very informative interview, and I just want to thank you for your time.
I want to thank you for yours as well, Alex. Good luck at UIC. Anybody has any questions, just email me at dan@optionthinker.com. So
all right, everyone, that is it. So if you want to contact Dan, you can do so through that way. But that's going to be it for today's Options Discovery interview. And I will see you guys in the next one. All right, bye.
Bye.
If you're hungry for more options content, make sure to subscribe to the JLN YouTube channel and check out our social media accounts. Be sure to check out our website, johnlothiannews.com, Markets Wiki, and the John Lothian newsletter for more content.